Trump announced tariffs across the globe. The S&P is down 10% in 2 days. Stocks across the board are selling off massively. The Fed made an announcement on interest rates today. China is hitting Trump back with their own tariffs, and Berkshire responds to a Truth Social post that Trump shared. It has been a wild couple of days in the market, and there is a lot we need to discuss. So let's get right into the video. The first thing that I want to discuss is how tariffs seem like they are actually being calculated. And I found this post on X where someone did this calculation and it pretty much came out to be exactly what the large tariff board that Trump brought out seems to be. So what this person is sharing here is that the EU exports $531 billion and imports $333 billion, so they have a deficit of $198 billion from the United States. So then the calculation is the $198 billion deficit divided by the $531.6 billion of exports to the United States, and that equals about 37%. And this seems to be the calculation that the Trump administration is using, because Vietnam, for example, does not have a 90% tariff on the United States. They just have a large deficit with the United States, and it seems like Trump is using this deficit and claiming that it is now a tariff. And what this suggests to me is that Trump is penalizing countries across the world for having trade deficits with the United States. In other words, this means that Trump is trying to incentivize these countries to buy more goods from the United States and lower their deficit. And ultimately, the United States wants to sell more goods internationally. What's also kind of funny is that Trump has placed tariffs on seemingly every region of the world without exception. For example, he placed tariffs on the British Ocean Territory, and this area of the world is inhabited by roughly 4,000 US and British military personnel. There are no permanent civilians on these islands. This means that he just placed tariffs on his own military. He also placed tariffs on the Heard and McDonald's Islands, which are a remote territory that's inhabited by only penguins, seals, and birds. So he's now tariffing the penguins, and it seems like no one and no creature is safe from Trump's tariffs. I also found this chart that shows the average tariff rates on US imports after all of this news. And the average tariff rate has now spiked to 22%. Relative to history, this is the highest it's been in 100 years now. This is a massive shift in global trade. And honestly, I'm surprised that the market isn't down more on this news. And I think that the fact that the market is not down more shows that people are optimistic that this level of tariffs is not sustainable and is not going to last. I also found this interesting post on X from Charles Gasparino where he says, Wall Street execs who have been dealing with the White House and President Trump himself say they are being told that the goal of the new tariff regime is to cut reciprocal deals to lower tariffs with trading partners. Business spending is grinding to a halt, and price elevation on goods is already happening. That said, if these trade deals can be reached and both sides begin lowering, not just tariffs, but trade barriers, the effect will be a long-term positive for markets and the economy. We are going to get short-term inflation and an economic slowdown. Wall Street executives are telling the White House that could appear in the second quarter numbers. So what this post is saying is that apparently Trump's ultimate goal is to reduce trade barriers with the United States and international countries, and ultimately lower tariffs after the negotiations happens. He's doing this by strong-arming countries into lowering their trade barriers through placing tariffs on their exports. And let's face it, the US has the stronger economy and is much more capable to deal with tariffs and an international trade war. Yes, they'll take a hit in the short term, but other countries will take much larger hits. So Trump is saying, hey, it's going to hurt us both, but it's going to hurt you a lot more if you don't make changes. And I think that this is all a negotiation tactic to get countries to lower their trade barriers and buy more from the United States. I personally do not see how this level of tariffs could be a long-term and long-lasting thing. I simply think that it is unsustainable. So I'm still hopeful that long-term this will all be resolved, as it's in no one's best interest to have insanely high tariffs. The US's largest companies are also being impacted by these tariffs greatly. For example, in 2023, Apple moved a large portion of its production out of China and into Vietnam. In this article it says, Apple's decision to build up its manufacturing in Vietnam coincides with the prolonged initiative from the iPhone maker to make its supply chain less reliant on China. Apple already makes several products in Vietnam, including AirPods and Apple Watches. In December, Apple moved some iPad manufacturing from China to Vietnam as well. Since 2019, Apple has invested $16 billion in manufacturing capabilities in the country. And since Apple has moved such a large amount of its production out of China and into Vietnam, it is going to be significantly impacted by the large amount of tariffs that Trump just imposed on Vietnam. Now today, on the morning of April 4th, Donald Trump also posted this. This would be a perfect time for the Fed Chairman Jerome Powell to cut interest rates. Cut interest rates, Jerome, and stop playing politics. So Trump is very clearly asking the Fed Chairman to lower interest rates, and he thinks that it's time to do so. Trump then reposted a video on TikTok. So I'm going to play this video really quickly, and then we will discuss it afterwards.
Trump is crashing the stock market by 20% this month, but he's doing it on purpose. And this is why Warren Buffett just said Trump is making the best economic moves he's seen in over 50 years. Now, here's the secret game he's playing, and it could make you rich. So why is he doing this? To push cash into treasuries, which forces the Fed to slash interest rates in May, and those lower rates give the Fed the ability to refinance trillions of debt very inexpensively. It also weakens the dollar and drops mortgage rates. Now, it's a wild chess move, but it's working. Now, you're probably wondering, what about his tariffs? Well, I'll tell you, it's a genius play. It actually forces companies to build here to dodge them. It also forces farmers to sell more of their products here in the US to bring grocery prices way down. We've already seen this with eggs. Now, remember, 94% of all stocks are owned only by 8% of Americans. So Trump, he's taking from the rich short term and handing it to the middle class through lower prices.
Now, by sharing this video, people are saying that Trump is admitting that he is intentionally trying to crash the stock market and trying to get the Fed to lower interest rates ahead of the $9.2 trillion debt refinancing that is happening this year. And ultimately, he wants interest rates to get lower so that the US can save money on interest payments. And he's doing this by tanking the economy and the stock market. Now, what's also wild is today Berkshire Hathaway put out a news release saying there are reports currently circulating on social media, including Twitter, Facebook, and TikTok, regarding comments allegedly made by Warren Buffett. All such reports are false. And this is in regards to Trump sharing that TikTok video on Truth Social. Because in that video, as we saw, he is claiming, or the person who made the video is claiming that Buffett said Trump is doing the right things, and this is the best economic policy that Buffett has seen in the past 50 years. It got so much attention that Berkshire Hathaway had to put out this press release and say that this is false, and that Warren Buffett did not actually say this. This is how crazy the times are that we are living in. Like, Berkshire Hathaway and Warren Buffett actually had to respond to a social media post, which is something that I don't think I've ever seen them do. Then I also found a summary on what the Fed said today. So the key points here are that tariffs are bigger than expected and risk higher inflation and slower economic growth. It's also too soon to determine appropriate policy path, which essentially means that the Fed is not planning to lower interest rates anytime soon. And it sounds like they're kind of in a wait and see period where they want to see how all of these new tariffs and this global policy that Trump is putting in place is actually going to affect the US economy and inflation. So they don't want to get ahead of it too soon, and they kind of just want to wait and see what's going to happen. Then the Fed also said, we must ensure price hikes don't lead to ongoing inflation. So the Fed thinks that tariffs could increase inflation, but what they don't want is for tariffs to cause long-lasting inflation. Because if they lower interest rates into increased inflation from tariffs, then that's like a double whammy that could cause inflation to get out of control. Basically, tariffs are inflationary, and lowering interest rates are also inflationary. So with these massive tariffs that are now being imposed, inflation could increase. So if the Fed lowers interest rates into that increased inflation, then inflation could increase even further, which is not what the Fed wants. So here's what my thoughts are on everything going on, and I summarized them in an X post earlier and also shared this with my Patreon community. So I wrote, I believe, number 1, Trump is trying to cause economic weakness to get the Fed to lower interest rates. Number 2, he is also knowingly weakening the US economy by placing global tariffs. And number 3, but he knows the US is better equipped than every country to deal with tariffs. Think about Vietnam. What are they going to do? They have no option but to negotiate now. Trump is forcing countries to come to the table and negotiate deals, instead of asking them to. I genuinely do not think Trump is as dumb as people make him out to be. He's playing the long game and forcing countries to make better deals with the United States. And no, I'm not endorsing Trump or saying I agree with or like him. I'm just sharing what I think his intentions are as another person trying to follow along. And as of today, this is my opinion on everything going on and me trying to read between the lines and tune out all of the noise. Again, I don't think that Trump is as dumb as people make him out to be. I think that people are making him out to be some idiot that has no idea what he's doing. But I think that he's actually trying to weaken the US economy so that the Fed is forced to lower interest rates ahead of the massive debt refinancing that the US has to do. Because if they can get interest rates down before that refinancing happens, then the US could save hundreds of billions, if not trillions of dollars over the next 10 years. So that's number one. Trump wants to weaken the economy so that the Fed is forced to lower interest rates. Then someone actually commented on this post saying, well, if tariffs increase inflation, then how is the Fed going to lower interest rates? Because as I said, both were inflationary. And my guess here, and the key word there is my guess, is that Trump wants to weaken the economy, which could potentially be a deflationary thing, which could offset the inflation from tariffs enough to force the Fed to actually lower interest rates. The third point here is also very important. I think that the United States is better equipped to deal with tariffs than every country in the world, and Vietnam is a perfect example. What is Vietnam going to do to the United States? The United States is pretty much bullying them to come to the negotiation table and work out a better deal for the US. So by Trump imposing tariffs across the world all at once, he's literally forcing every country to come to him because the US is in the position of power. Let's put it how it is. I'm a Canadian, but I know the US has the cards, all right? So he is forcing all of these countries to come to him now and negotiate deals. And I think that we're now seeing this play out in real time. For example, earlier today, Trump posted this. Just had a very productive call with To Lam, General Security of the Communist Party of Vietnam, who told me that Vietnam wants to cut their tariffs down to zero if they are able to make an agreement with the United States. I thanked him on behalf of our country and said I look forward to a meeting with him in the near future. So Vietnam is already trying to negotiate deals with the United States to lower tariffs on both sides down to zero. This could ultimately increase trade between the United States and Vietnam, which again, I think is Trump's ultimate goal here, is he wants to actually increase the United States trade and exports with countries around the world so that the US can generate more revenue and ultimately lower their deficit because the US has way too much debt. Again, I think that this is actually playing out in real time where countries are now negotiating with Trump to get better trade deals. What's also interesting is Lululemon and Nike spiked on this news that Vietnam is coming to the table and trying to renegotiate because Nike and Lululemon make most of their clothing in Vietnam. Those two stocks absolutely tanked yesterday. But now that Vietnam is trying to renegotiate with Trump and get tariffs down to zero, the stocks are back up because ultimately they don't want Vietnam to have high tariffs on them. And the companies would be pretty significantly harmed if this remains intact. Cambodia's prime minister also told Trump that he is willing to drop tariffs on US goods. And again, I think Trump is forcing these countries to respond and renegotiate trade deals by inflicting pain. The issue is that this is a risky play, and it is harming international relations regardless of the outcome here. China also responded to Trump's tariffs by imposing their own 34% retaliatory tariff on the United States. And the EU is now working together to come up with its own retaliation plan against Trump. So while the smaller economies seem to be caving in pretty quickly, the larger ones with more power seem like they do want to put up a fight. And in the short term, this is likely to cause economic pain for everyone involved, and negotiations are going to have to take place eventually. We are living in a very weird, volatile, and uncertain world right now. Tom Lee also did an interview and shared his thoughts on the market right now, so I want to play this interview and then discuss the key points afterwards.
Let's now bring in Tom Lee of Fundstrat, Dan Greenhouse of Solus Alternative Asset Management. Tom's a CNBC contributor. It's so good to have you both with us. Tom, I know you agree with a large part of what the professor said. That's what you're trying to do and impart on our investing audience. Those are the headlines from the notes that you continue to put out. Tough now, better later. Invest for the longer term this year.
That's right. We don't want investors to be panicking now or rage selling. We've had a very painful drawdown, and I know we're facing this huge uncertainty that may not end tomorrow, might last months. But like the other declines in stocks, like the one last year or the ones in 2022, the ones who could endure that short-term pain and took advantage of those declines are going to have good opportunities.
Dan, what if things are different, though, this time? That these tariffs are going to be a favored measure by this president, whether they're permanent, temporary, months, years, no one really knows. They're not going to be a day. Know that.
Yeah, listen, across the street, every big bank, every medium-sized bank, I'm sure Fundstrat have hosted calls with their clients to discuss what they expect for tariff. And I've been on a couple of those calls, and there's universal, complete uncertainty as to what's going to be announced in even 45 minutes time, let alone 45 days time. So I think it's fair, to Tom's point and to the professor's point, for everybody to have a little bit of fog in their investing outlook right now. However, I want to take a step back here and just note, to the professor's point, that stocks are long-lived assets. Risk assets are long-lived assets. And unless you think a recession is forthcoming and a meaningful decline in earnings is forthcoming, then probably your best bet is to ride this out. And to your point about EPS, 280 right now for the next 4 quarters is basically unchanged over the last couple of weeks. Now, you could say that's the ignorance of the market, thinking that this isn't going to matter, and someone thinks it does. But it also could be telling you that maybe the tariff headlines, which populate all the newspapers, aren't quite as bad as the reality on the ground.
All right, so here's my notes from this interview. Tom Lee starts off by saying he thinks people should be focusing on the long term, and he's telling people not to panic. He thinks the people who can endure the short-term pain will be able to find opportunities in the markets, and I actually do agree with him. I do think that people should be focusing on the long term and not getting so caught up in all of the uncertainty that is currently going on. I think that we are in one of the most uncertain times, and as we saw with Vietnam and Cambodia, I actually think that these countries and economies around the world are going to try and figure this out because it's in no one's best interest to have such high tariffs placed on them. So I think that the tariff rates are going to continue coming down and negotiations are going to happen over time. Then I wrote, I don't know if stocks will continue to go down or where the bottom is, but I will be buying, and I am actively buying in this market right now. This may seem naive, but you don't get great prices when everyone is optimistic. You get them when people are worried. And I wrote this yesterday on my Twitter as well, that the market that we're currently in, with stocks dropping 5% day after day, if not more, is something that I haven't seen since COVID. COVID was a period where the future of the world was extremely uncertain. I would argue even more uncertain, well, probably about as uncertain as right now. I mean, no one really has any freaking idea what's going on. But COVID was a very scary time in the market if you were around back then to be investing. But what I'm trying to say is, you don't get price action like we're currently seeing outside of massive uncertainty. Stocks don't just randomly fall 5% day after day when everyone is optimistic on the economy, companies are posting great earnings, everyone is happy, and it's obvious that the market's going to be fine. You get the best discounts and you get days like today when people are worried and when the future is actually very uncertain. So you have to be willing to buy into the uncertainty to get the best prices and to take advantage of the best prices. Now, again, I don't know where the bottom is going to be, and no one knows where the bottom is going to be. So what I do instead is I try to focus on value. And what I mean by that is every stock that I buy, I am asking if I am happy with its price today. I also ask if I think the company is going to be more profitable and a larger business in the future. Because if I think the company is going to continue to grow over the long term, and I'm also happy with its price today, then I don't need to try and time the bottom because I am happy with the price I'm paying and I think that I'm buying a high quality business. So while everyone is so focused on the short term and worried about maybe the next year, 2 years, 3 years, and how this is all going to play out, I think that you can gain a serious advantage by focusing on the long term. And by long term, I literally mean 5, 10, 15, 20 years. So when I'm taking a look at Amazon, for example, I ask myself, do I think that Amazon is going to be a better and bigger business in the next 5, 10, 15, and 20 years? And to me, it's an absolute no-brainer yes. And therefore, I ask myself, do I think the price of Amazon today is looking attractive? And it absolutely is. So I'm getting a great business at a great price that I think is only going to continue to compound and grow over the long term. I don't think that Amazon's business is going to be disrupted permanently by what is currently going on. And I think that the world is going to figure this out eventually. I don't know when, but eventually. And if the stock continues to fall, then, I'm someone that has consistent income coming in. I have oriented my life around living cheaply and having a high amount of personal free cash flow. I mean, guys, look at my freaking studio. Like, I haven't upgraded my studio in 4 years. I have not increased my expenses at all. But as my income has grown and my expenses have stayed flat, my free cash flow has grown. And that is what allows me to take advantage of these markets and kind of not try and time the bottom because I have cash coming in consistently. So even if I run out of cash today, within the next month, I'm going to have some more cash coming in, and I'll just continue buying and buying and buying what I think are great businesses. And this is how I remove emotions from my investing and from my portfolio, is I know that I can continue to buy, and I have conviction, and I know that I'm buying fundamentally sound businesses that are going to continue to grow over the long term. And this drama that's going on in the global economy today is not going to affect them in 15, 20 years. So I can take advantage, and emotionally, I am prepared to buy into the selling. And again, some people may think that this is naive, but I think it's investing. I think that this is what the best investors in the world do, and all I'm trying to do is emulate them. And as I wrote right here, the intelligent investor talks about this in chapter 3, and how historically, the S&P's earnings have continued to grow through world wars, pandemics, the Great Depression, and so much economic uncertainty. So you guys have to know that when you zoom out, business fundamentals tend to improve. And the overall S&P, if you don't want to buy individual stocks, then just think about the overall S&P. When you take a look at the past 100 years, and the intelligent investor does this in chapter 3, it takes a look at every single decade over the past 100 years, and there was only one period after the 1900s where the S&P's earnings declined. So out of all of those periods in the 1900s, again, through pandemics, 2 world wars, so much economic uncertainty, massive inflation in the 1980s, the S&P's earnings continued to grow, and the fundamentals of businesses continued to improve. So I think that people need to zoom out. And I also think that just taking a look at the historical data and how resilient humanity is and how resilient businesses tend to be, it should give you optimism to buy into the weakness and focus on the long term, and simply just continue investing through all of the drama that we see in the short term. So now let's continue on to what I have actually been buying. I have not been buying Microsoft, but Microsoft is getting to a point where I do think it is looking very attractive. So Amazon is down 4.1% on the day. If we take a look at a 1-year view, the stock is now down 30% from its all-time highs. And that's a pretty massive correction for a business like Amazon. But I'll show you why I think that this business is cheap. So let's head over to Stock Unlock's freeform tool really quickly. And the metric that I use for Amazon and all of the large tech companies right now is price to operating cash flow, because they're going through massive CapEx cycles that I personally think are going to pay off. So free cash flow is being artificially lowered right now. So to factor out that free cash flow, or to factor out that CapEx, and get a better, more accurate view of how these companies have been valued historically, I think operating cash flows are the move right now. So Amazon's price to operating cash flow on average over the past decade has been 26.6, and its low over the past decade is actually right now. We can see that its low was today on April 4th of 2025. So Amazon is literally selling at a decade low price to operating cash flow multiple right now today. It has not been cheaper over the past decade, even during COVID, okay? And even in the dip that we saw in 2022. And this is because Amazon's profitability and fundamentals have grown as the stock price has also grown. That's how these things work. Now, if we actually zoom out, the last time that Amazon was trading for a price to operating cash flow of 16 was down here in February of 2010. And before that, the lowest its price to operating cash flow has ever been was about 13 at the pit of the financial crisis, okay? So Amazon is approaching this level. It's not quite there yet. It would have to drop about another 15% to get down here. But when you zoom out, this is the cheapest that Amazon has been in 15 years now, okay? That is how low this stock is getting. That is how pessimistic the market is on Amazon right now. And when we take a look at Amazon's fundamentals here, when we take a look at its revenue is continuing to grow extremely consistently and hit all-time highs. When we take a look at Amazon's cash flows as well, we can see that its operating cash flows are sitting at an all-time high right now, and I personally believe that Amazon's operating cash flows and profit potential is going to continue growing, with AWS and its high-margin business segments growing at a faster rate than the overall revenue. As I have shared on my channel before, Amazon's high-margin businesses, again, AWS, its advertising business, its 3PL business subscriptions, all of these businesses are higher margin than the retail business, and they're growing at a faster rate. What this is leading to is Amazon's overall margins continuing to improve over time. And its gross margin is at an all-time high in the most recent quarter at about 49% now. And we can see that back in 2011, it was 22%. So Amazon's gross margin has more than doubled over the past 15 years, due to its more profitable businesses making up a larger and larger portion of the overall business. And as time passes, I think that Amazon is going to continue becoming a more profitable business and seeing its margins expand, which ultimately means that I think its profits can grow at a faster rate than revenue over the long term, as, AWS and everything continues to grow. So while this business is trading for literally a 15-year low price to operating cash flow multiple, I am taking advantage because I think this business is going to be much larger in the future, and I think its profits and fundamentals are going to continue to grow over the long term. So while the market is pessimistic and giving me a 15-year low price multiple, I'm just focused on the long term, and I am absolutely taking advantage, and I'm buying a lot more Amazon. I've actually been buying pretty much every day. And as it continues to fall, I'm just going to continue buying. Now, the next stock that I've been buying is Brookfield Corporation, and this should surprise absolutely no one if you've been a long-term viewer of my channel. This is the largest position in my portfolio, and if we take a look now, the stock is now down 25% from its all-time highs, and I think that Brookfield is not going to be affected by tariffs. I recently shared an interview on my channel where the CEO, Bruce Flatt, was asked about tariffs, and he said that Brookfield doesn't really do a lot of business over borders. They are an international company and they have exposure to dozens of countries across the world. But what they do is they set up shop in India, for example, and then that India business works within India. Its India business is not really shipping products over to the United States, for example. So they have local businesses and economies across the world, and that's how they operate. So again, they're not moving a lot of product over borders, and therefore they shouldn't be impacted by tariffs too much. They also pretty much, this business, its entire purpose is to own and build the backbone of the global economy. So a lot of their contracts or their revenues are contracted to grow with inflation. So if tariffs cause inflation, let's say tariffs cause 10% inflation, then Brookfield has it in their revenue contracts that they can raise their revenue by 10% to match whatever inflation is doing. And they have that ability because they're literally, they own the backbone of the global economy. And therefore, their business has to remain profitable, and they have all the cards. So this is a fantastic business. And I actually want to share a clip from a great interview that Bruce Flatt just recently did. I would recommend watching the entire interview that he did. It's over an hour long. But if you're a Brookfield shareholder or you want to learn more about Brookfield, I would definitely recommend watching this entire interview because it was incredible. So I'm going to play the clip that I want to discuss right now, and then again, we'll talk about it afterwards.
You have over $1 trillion in management now. How do you fend off the pressure to deploy that money?
It sounds like a lot of money.
It is a lot of money.
It sounds like a lot of money.
It's $1 trillion.
But it's not that much when you do what we do. A couple of years ago, we bought Deutsche Telekom's, half a Deutsche Telekom's telecom tower business in Germany and Austria. It's a $20 billion transaction. We're building for Microsoft $13 billion of power plants. We're building with Intel a $32 billion fabrication plant in Arizona. I can go through the list. These are large transactions that consume significant amounts of capital that earn excellent long-term returns. And I would just use that to say we've been doing this a long time. What we promise our investors and our clients is that we will take moderate amounts of risk, not no risk, but moderate amounts of risk, and earn good returns over long periods of time. We won't shoot the lights out. You're not going to get 45% returns every year. And we're not trying for that.
But average returns over an above average period of time equal outstanding returns.
Yeah, and that's the point. The point is our parent companies earn 19% annualized returns for 30 years. When you compound up, which doesn't sound like very much, 19% returns annualized for 30 years. Like when you say that in that line, doesn't sound like that much, but I think that's $1 million became almost $200 million over that period of time, or $1,000 became $200,000. It's a lot. And so the point is, success in investing isn't about making a lot of money in a short period of time. What it's really about is earning reasonable returns over very long periods of time. And look, that's Berkshire Hathaway. Berkshire Hathaway is successful because they have been able to deploy capital at reasonable amounts of return over very long periods of time. And that's the success of long-term investing.
Is that a company you look up to?
Look, they've done an incredible job in their business over a very long period of time.
All right, so here are all of my notes from that interview. First one is that $1 trillion isn't that much when you have a business like Brookfield, which is kind of insane to think about. But then Bruce Flack gave us the example that they just did a $20 billion telecom transaction. They did a $13 billion power agreement with Microsoft, a $32 billion deal with Intel, and recently, he didn't say this in the video, but recently they signed a $30 billion contract with France to develop data centers in the country. And right here, this is pretty much $1 billion worth of deals going on. And that's just within 4 deals. And Brookfield is doing these types of deals all the time, all over the world, and they have a lot going on. So $1 trillion in assets under management for a business like Brookfield that's doing these tens of billions of dollar projects, he's saying it's not really that much capital and they can actually effectively deploy it. Then he said that Brookfield takes moderate amounts of risk to produce above average returns over the long term. The company's goal is not to make 45% per year. And over the past 30 years, the company has produced a 19% compounded annual growth rate, which works out to roughly a 200x return. And this is what they want to do over the long term. Brookfield's goal, what they tell investors, is actually to produce a sustainable 15% compounded annual growth rate over the long term. Over the next 5 years in specific, they believe that they can see accelerated growth, and they're actually projecting to grow profits by 25% per year over the next 5 years. I personally think they can still do that. But over the long term, they believe that they can compound the business by 15%. And over the past 30 years, they have done this and executed on it. And it's what the business is built to do. So I'm not going to produce, 40% annualized returns on this position, but I'm quite confident that over the long term, I can produce market-beating returns with this one. Then he says, success in investing isn't about making a lot of money quickly. It's about making a good return over a long period of time. Berkshire Hathaway does this. They focus on making good returns over the long term and not making a crazy amount of money quickly. And then he always says, focus on the long term. So I thought that this was another really good interview by Bruce Flatt, and that's why I wanted to share it with all of you. Now, there's also a lot of other Brookfield news coming out right now that I want to quickly discuss. And the first one is that Brookfield is nearing a $9 billion deal for Colonial Pipeline. Colonial Pipeline is the largest U.S. fuel transportation system. On Colonial's website, they say, "We are a lifeline that allows Americans to enjoy the freedom of mobility while supporting our military with the fuel they need to defend our great nation and enabling commerce to sustain the nation's economy. For more than 60 years, we have safely and responsibly transported fuels to serve American communities, commerce, travelers, and military installations. We are America's largest refined products pipeline by volume, proudly delivering more than 100 million gallons of fuel every day on a system stretching from Houston to the New York harbor. The company serves over 50 million Americans. They have over 45 military installations served. They have direct connections to 8 airports and 4 terminals owned." So this is a massive pipeline across the United States that Brookfield, I believe they actually just won the bid, and they purchased it for $9 billion. And when I say that Brookfield invests in the backbone of the global economy, this is exactly what I mean. They just bought the largest pipeline in the United States that serves over 50 million Americans. The US military ships fuel across the world, serves 8 airports, and they own 4 terminals. When I think about a company that could be resilient to a recession or is absolutely going to continue producing cash flow for decades, it would be something like this, something that the economy absolutely needs. And that's what Brookfield's business is focused on. Brookfield Asset Management also announced that it is acquiring a majority stake in Angel Oak to form a strategic new partnership. In this article, it says, Brookfield Asset Management and Angel Oak Companies, a leading asset manager delivering innovative mortgage and consumer products, today announced that they have entered into an agreement in which Brookfield will acquire a majority ownership stake in Angel Oak and offer its investors access to the firm's residential mortgage credit strategies. Since its founding in 2008, Angel Oak has grown into a premier alternative asset manager with over $18 billion in AUM. The firm provides differentiated access to U.S. non-agency residential mortgages, Over the past decade, Angel Oak has originated more than $30 billion in residential mortgage loans. With Brookfield as our partner, we see significant opportunities to scale our integrated asset management and mortgage operations to better serve our clients. Angel Oak will continue to operate its business independently, retaining its current leadership, including Prabhu and Fierman as co-CEOs. So Brookfield Asset Management just acquired an $18 billion portfolio, essentially, of mortgage securities. And now what they're going to do is offer their own clients and customers access to Angel Oak's portfolio. This could accelerate the overall growth of Angel Oak, and Angel Oak is going to remain pretty much a subsidiary that's managed on its own. But Brookfield is making deals, and they're taking advantage of the global uncertainty, and they're continuing to deploy capital and acquire businesses. And this is exactly what I want to see as an investor, is businesses focusing on executing and not focused on the short-term noise that is going on. All right, now the last stock that I have been continuing to buy is Meli or Mercado Libre. This one is continuing to fall on all of the tariff news. They are a Latin America company that owns an e-commerce business like Amazon and a digital bank. They're pretty much the digital banking company of South America. They're also the largest company in South America, by the way. This company is continuing to grow its revenues by around 40% annually. I think that they're going to be just fine with tariffs because they don't actually export to the United States. The United States does export into South America, and Meli handles that distribution, but Meli is not actually exporting to the United States. So I think that this business is very resilient, and it's actually going to be fine during tariffs. The CFO also recently did an interview where he was asked about tariffs. I'm not going to play it because this video is getting way too long, but he was asked about tariffs and he basically said it's not going to impact our business. So while the stock is falling and the fundamentals of the business, in my opinion, are not going to be impacted that much, like I actually think Meli is going to continue to grow, I am just taking advantage of the cheaper price. This business, after today's drop, is selling for about $93 billion, which is about 18 times my estimates of the business's cash flow. So when I take a look at Meli, I'm seeing 18 times cash flows as my going in price, and this business is growing by 30 to 40% annually. So I think that it is an absolute steal. And again, as its stock price is falling, I'm continuing to increase my position in it. Now, I've also bought a lot more stocks in the market, but as I have told you guys on my YouTube channel, I do own a lot of smaller cap companies that are kind of illiquid and don't trade very much. And I don't want to talk about them on my public YouTube channel because, again, they have very low volume. And if I talk about them, the stocks can go up a lot. And I do not want to in any way look like I'm trying to manipulate stocks, all right? It actually scares me. So I'm not taking that risk. But what I do is I do share these stocks with my Patreon community because it's a much smaller community. And therefore, we're not going to move these types of stocks. They are low volume, but we're not going to move these stocks. So I do talk about these stocks in my Patreon community. And if you do want to see my portfolios and all of the stocks that I am buying that the YouTube channel does not see, then you can check out my Patreon. It's only $15 a month. You'll get access to monthly portfolio updates, all of my buys and sells, my portfolio, I share it all of the time, and dozens of Patreon only content as well. It's a great community. People have been absolutely loving it, and I think that you will too. So check it out. I'll leave a link in the description. And that's going to wrap up the video for me today, everyone. So thank you all so much for tuning in. We're living in some absolutely wild times. It's my job to stay on top of everything. And I feel like if I miss a day, I'm going to be behind right now. So things are moving so quickly. And I'm just doing my best to share my opinions and keep you guys updated. So if you enjoyed the video, please leave a like. And if you want to stick around and get more, then please consider subscribing to the channel as well. But I can feel my voice giving out now. So thank you all so much for tuning in. I'm going to wrap up the video. And I really hope to see you all again in my next one.